Hello everyone, welcome to a new Day Trade to Win video. Today is Friday, September 29th, 2017, and what is going on with these all-time highs being made on the S&P 500 and the E-mini S&P? Well, I can tell you that this was expected for 2017 using the January effect, and if you followed any of our videos, now close to 500 and counting, you've probably learned how we teach and look at price action, showing traders from all over the world on what to do based on how these prices and candles and manipulation actually moves the markets. Before we begin, let me provide to you the following disclaimer about the risks of trading futures or any trading product. Trading involves unlimited reward as well as unlimited loss. Past or hypothetical performance is not indicative of future results. Please don't trade with funds you cannot afford to lose. All right, now to begin, what you're seeing here on Friday is the Atlas line. And the Atlas line is software that provides entries long and short, as well as pullback and strength trades. So for most of the day, we have the market providing these long opportunities. But in actuality, if you were looking at taking a longer term position or having the bigger picture, if I switch to a daily chart, and a daily chart, the daily chart allows me to see the bigger picture of what the year happens to be telling me. Now, the way the January effect works, and I invite you to look back at previous videos where I explained this in detail, starting at the beginning of the year all the way through the middle of the year, and now as we get towards the last part of the year. Starting in January, what I want to do is look at whether or not the month of January closed higher than where it opened. So when you look at the opening price of January in comparison to the closing price of January, right as we start February, the month closed higher than open and it was up month. That sets off the January effect. This tells me historically, very high percentage of the time, that the year will close much higher. Now, it doesn't mean we have to buy it and hold it, although that may have been a great opportunity to do that. But it does tell me that every time the market makes new highs or pulls back and then continues higher, these are great opportunities to take advantage of bull long-term buys. So what I want to do is I want to look at this idea of retracement. So it has to be something specific and significant enough that there's a pullback in place where eventually the market will stop and then continue back up to test those highs. That's one way that I like to look at going long to test the highs where the market has been. So if I'm looking to go long, why not go long once the market makes a good retracement, at least 5, 6, 7 days, something that you can, not a small little chop, but a good retracement and then a continuation. We have a tool here that I've actually updated and changed to only reflect the 50% marker. And this tool allows me to understand that it stopped and begins to climb back up. Now, this is a Fibonacci retracement tool. Every charting platform has it. I'm not using any type of Fibonacci's. I don't believe in them, but I am using this tool to understand the 50% retracement back up to where the highs have been. As we start moving here, going long and testing these highs was expected and it happened. And if you look at the ATR, this is a great 20-point move, at least from the midpoint. It's 41 points. Now, the key is not to enter exactly at the 50% marker. It's letting the market break through with a little momentum on its way, breaking it and coming back up. So don't have a long entry exactly at the midpoint from where it stopped the retracement. As it breaks to 50 and comes back up, enter a few points beyond that. So you're going with the momentum. Your stop would be here. That's a pretty big stop. It's not for everybody. If the market starts to go against you, get out and then re-enter. Markets love to test where they've been, and this is a great example of that. The other part of this move is every time the market breaks these highs, accept or expect the market to move higher. Therefore, if you take a look how the market broke here these highs and broke them again and then made a huge significant retracement and started to come back up, it's a great example to look at going long, again, not at the 50%, let it break it by a few points and then jump on board to test where the highs have been. We have it again here in June as the market begins to break up and continue and continue. We have a nice significant retracement, and then you can see for the third time the market is now coming back and testing the highs after it breaks the midpoint. Here's your stop down here, pivotal point. After it breaks the highs, you're long. Again, great 15, 16 point opportunity. And if you take a look at the move is 25 points. So I'm actually being more conservative than what testing the highs actually brings. As we continue now, what happens? Huge retracement here. It broke the highs, continued higher, all normal part of price action. And now, as you look at coming back to test the highs, remember, a few points after it breaks the midpoint, you're long. This could be a day trade. You can go long the Atlas line. You can go long for the day. I mean, this is just a great opportunity to look at when September 1st, even August 30th, when this all comes and starts being long days, the only type of trading you should be doing is long. And now it tested the highs. What can you expect? 36 points distance. Again, you're looking at about 17 points. So the actual move is much larger than what you can expect on just being conservative on these numbers for the profit. Now, in addition, once it breaks the highs, you can see that it broke it and continued. Here we are at the moment. I can't say that this little 5-day move is significant. I don't think it is. It may be more of a range or a chop. So let's not look at that in particular because it retraced, but really not enough for me to call it what it is. We are now at these all-time highs here on Friday. How do we proceed moving forward? It's very simple. There's going to be a week that the market is going to do this. It could be a 20-point retracement, a 30-point retracement, but it has to be a good, significant move that you could look at it and say, this is definitely turning around. When it stops and begins to crawl back up, the same idea, it's happened 4 or 5 times already throughout this year. It happens almost every January effect year. If you look back in history, you're going long after it breaks 4 or 5 points, 3 points. Just make sure it breaks the midpoint and to test the highs. Now, it may not make the highs. It may just get short or become short of it. So look at the ATR as a guide for a profit. And if you're not sure what the average true range is, the ATR, or how we use it and teach it at Day Trade to Win, take a look at any of the videos. Do a search for ATR on the YouTube Day Trade to Win channel. And if you like our videos, subscribe, send me an email. I'm happy to help anyone out. I would expect to see this at least one more time until the end of the year. And then in January 2018, look for the January effect all over again. We've had plenty of examples for the last 10 years of the January effect being very successful up years if you played the market like this. Have a great day. Email me if you have any questions. October 10th is the next mentorship class. If you'd like to learn these and more price action methods, sign up, and I'll see you at the next class.